What if you could earn real income and pay little to no tax on it, legally? If you're a high income earner or a retiree and taxes are one of your biggest expenses, this video is for you. Today, we're talking about one strategy, bonus depreciation, and how sophisticated investors use it to significantly reduce and defer taxes. This isn't a loophole, it's not aggressive, and it's not something most people know how to implement. In the next 5 minutes, I'm going to show you how a $2 million property can generate a $1.7 million tax deduction in year one. We'll cover the mechanics, the math, and the step-by-step implementation. Fair warning, this is not beginner content. But if you care about scalable, passive income, and tax efficiency, this is one of the most important concepts to understand.
Quick clarification. This strategy applies to retirees who own or plan to own investment real estate, including passive net lease investments. If your income is mostly from pensions or retirement accounts, this won't apply. And as always, I'm not a CPA. Consult your tax advisor. Taxes aren't just the price of success. They're a function of how income is structured. The tax code rewards ownership, not effort. And nowhere is that more true than in private real estate, especially net lease, where you get scalable, passive income, long-term contracts, and powerful tax treatment without being a landlord or operator.
Now, let's break down exactly how bonus depreciation fits into this. Here's the foundational idea you have to understand. Cash flow and taxable income are not the same thing. You can receive real income, money hitting your bank account, without being taxed on every dollar of it.
That sounds illegal to most people. It's not. It's how the tax code is written. The IRS allows investors to depreciate real assets over time. Buildings age, systems wear out, value gets allocated across years. So even when a property produces strong, steady cash flow, the tax code allows you to report much lower taxable income on paper. That's depreciation.
And in net lease real estate, this works especially well because the income is predictable, while depreciation quietly offsets it in the background. But here's the part most people never realize. Standard depreciation is slow. Commercial buildings are depreciated over 39 years. That means the annual tax benefit by itself is modest. Helpful, but not game-changing. That's not the strategy sophisticated investors are excited about. The real leverage comes from bonus depreciation. Bonus depreciation allows investors to accelerate depreciation forward, taking deductions now instead of spreading them thinly over decades. This concept first came out of the 2017 Tax Cuts and Jobs Act and was originally scheduled to phase out, but in 2025, Congress brought it back. As part of what President Trump famously called the Big Beautiful Tax Bill, 100% bonus depreciation was reinstated.
That's a big deal because it means that in the right situation, an investor can buy a cash flowing property and write off 100% of the qualifying depreciation in year one, not over 39 years, year one. Real income coming in, large paper losses showing up, not because the investment lost money, but because depreciation was pulled forward.
And one important note, if you're selling real estate and planning to buy more real estate, bonus depreciation is powerful, but it's a timing tool. If you're looking for forever deferral, the 1031 exchange is your best friend. And I'll show you how to stack both in the next video. For this video, though, we're staying focused on bonus depreciation.
Now let me make this real with a simple example. Say you buy a net lease convenience store for $2 million at an 8% cap rate. That's $160,000 of annual rent. Cash flow is steady, and rent shows up every month. Now here's where bonus depreciation comes in. A cost segregation study breaks the property into components that qualify for accelerated depreciation. And in a typical net lease deal like this, roughly 85% of the purchase price typically qualifies for it. And this works really well for certain net lease assets like convenience stores, because the tax code allows much of the building to be depreciated far faster than a typical commercial property. And with 100% bonus depreciation, that means you could generate roughly $1.7 million of paper losses in year one. And that depreciation can be used to offset the income from this property and also offset other passive real estate income that you already own.
One vital distinction. These are passive losses. And unless you qualify as a real estate professional, you can't use them to offset your W-2 salary or interest income. They are specifically designed to shield passive income, like the cash flow from this property or other real estate investments. If the loss is bigger than your income, it simply carries forward to shield you in future years.
And this strategy works whether you own the property outright or invest as a passive limited partner in a private real estate deal. Same depreciation rules, same K-1 treatment, same tax mechanics. The difference is how hands-on you want to be, not how the tax code treats you. The big takeaway is this. Bonus depreciation isn't about avoiding taxes, it's about timing and control. When you understand the difference between cash flow and taxable income, you stop optimizing for returns and start optimizing for after-tax income. And for retirees who own real estate, that distinction matters. In the next video, I'll break down the other major strategy retirees can use that own real estate: 1031 exchanges, and when they make more sense than bonus depreciation. This is Mailbox Money. I'm Net Lease Guy, turning stress into sunsets, one lease at a time.